Good afternoon. Thank you for joining us for today's webinar. A little mid-year update. My name's Sean O'Brien. I'm the president of QwickRate. And as always, I'm pleased to be joined by David Ruffin. David heads up our IntelliCredit division, and he'll speak to the credit quality of this quarter. And also pleased to be joined by Dan Marks. Dan heads up the marketing services group and services team here as well. So the three of us will kind of tag team this for today. And we appreciate you making some time from your busy schedules to join us. Just kind of a quick reminder, we'll really kind of cover the QCBI results. David's going to talk about credit. Dan will focus on consumer and business trends they're seeing in the marketing services area. We'll talk a little bit about some of the updates from QwickAnalytics and IntelliCredit. And as always, have time for your questions. Regarding questions, certainly use the chat feature, the Q&A feature. We'll monitor those throughout the presentation and either interject them in the midst of the discussion or certainly at the end of the presentations. As always, we start with a few polling questions. Just a reminder, we will send a link, or excuse me, an email with a link to the presentation and the recording. So look for that. Today's Tuesday, probably either Wednesday afternoon or early Thursday morning. So certainly look for that, and certainly appreciate any participation you might offer here on the polling questions. So just three today. We'll go ahead and get started with those. The first one is, over the next 12 months, what concerns you the most? Loan growth, deposits and funding, credit quality, policy and regulatory, political uncertainty, weakness in the economy, or customer growth. And you can answer multiple responses. So as always, we'll give this 30 to 45 seconds and then move to the next question.
And it says host and panelist cannot vote. So this is pure audience participation.
That's right. No swaying. No swaying. Okay, we'll end that one and share it. Leading the way, credit quality and deposits and funding, not surprisingly, and then weakness in the economy. So again, thank you for participating on that one. The next two just around deposit growth and loan growth. Simple yes or no. Are your deposit growth plans on budget through the second quarter? Okay, and that one, share the results. 61% of you responded yes, 39% no. And then the final question, again, thank you for participating. Just the same question around loan growth. Are your loan growth plans on budget through the second quarter? Simple yes or no. Okay. All right. Thank you again. Similar results. 70% of you yes, 30% of you no. So again, I think certainly encouraging to see. I think kind of in many ways mirrors kind of what we're going to see here in the second quarter numbers. But again, I think we it's kind of steady as she goes, right? There's the bank performance through the first half of the year has really been solid in spite of all the uncertainty. Loans and deposits grew at the median, right? NPAs continue to slowly rise, but the reserves remain solid, and median charge-offs are still zero. So again, for the most part, everybody's managing this uncertainty very well. Across the board, NIM, cost of funds, and earnings all showed improvement that we'll discuss here in a second. I continue to put this slide up. I was looking at it again this quarter, and I thought to myself, should I put this slide up? I put it up every quarter. And I thought, yeah, I'm going to. And part of the reason was I was thinking back in my much younger days. I coached high school basketball when I worked at a community bank. And I remember having the opportunity to go to coaching clinic hosted by Mike Krzyzewski, and he talked about saying things to your team is different than emphasizing things to your team, and that he said, every coach knows what to say to a team. He said, but it's what you emphasize, and there's only a limited number of things you can emphasize. That's really what your team's identity and character will be about. And it strikes me, we all know deposits are the lifeblood of our industry. And so I just don't think you can ever emphasize it enough, right? It's always been a competitive landscape. And I just think increasingly for community banks, it remains competitive. And so I just don't want to ever not emphasize deposits. And again, I think we within our institutions, know all the sources of disintermediation. But I just, again, throughout these quarterly presentations, I just want to make sure we're continuing to emphasize, what our strategy is, what our dedication, what our emphasis is to trying to continue to grow deposits within our institutions. I also have, kind of remained a couple of these next two slides just on the focus on uninsured deposits. For many of us, again, it remains a focus of regulators as we talk to our banks. So, again, I want people to be mindful that this is going to continue to probably be a conversation. And again, I think the mitigation or the mitigating factors can be just confirming or identifying or acknowledging or just demonstrating that you have the coverage capacity of those uninsured balances, because those are likely the first to move. And so, within your liquidity structure, you're going to certainly want to make sure you can demonstrate to auditors and regulators that you can cover those in the case of an immediate or sudden exodus from the bank. And then the underwater securities. Again, this is improving every quarter, which is great to see for the banks that are still kind of swimming with this, a little bit of an anchor around them. Again, I know it's tough for them, but this problem is seemingly getting better. So again, just want to kind of highlight this, just because if you are one of these banks, if you have any other issues, it certainly kind of extrapolates or exacerbates some of the challenges you might encounter. So looking at the 630 numbers, asset growth, you really can see over the last 3 or 4 years, it's just been kind of steady. I heard someone the other day say, hey, kind of just steady, solid growth is what banks, kind of thrive in that environment when there is some certainty, and it would just kind of, moving forward. And, so we've, a little bit better asset growth, loan growth, a little bit off from 2024 numbers, but, again, still pretty solid. And I think more importantly, as you look at what the loan growth has been for, going back to 2022, 23, 24, and if you look at those numbers in 2020 and through the first 6 months of 2025, and compare it to the deposit growth, right, we're kind of catching up, right? Back in 2022, think about that. At the median, we had almost an 8.5% deposit deficit. In 2023, it was almost 7% of deposit deficit. 24, it got better. We were only about a 1.5. And then this year we're almost even, right? And so it takes some of the urgency off of feeling our liquidity is really strained. It's still a deficit, but certainly not what we've encountered over the past few years. So again, a slide on emphasizing deposits. I think we're all taking it to heart. We're working hard, and we're in probably in a pretty good spot where for most institutions, at least around the median numbers, deposit growth isn't lagging as much as our loan growth. And you can see down in the bottom slide here, deposit growth other than the 0 to 100, all about the same here at the median. So the question came in: is there a reason many of the banks with uninsured deposits aren't using IntraFi to cover those funds, or are they using it but not all of the uninsured deposits? Yeah, I mean, I would think that the solutions like that, they would certainly look to do it. Oftentimes, just depending on the relationship, they may not. But yeah, I'm surprised with some of the larger numbers that's not occurring. So thank you for the comment. Yield on loans continues to be really strong for community banks. This is really encouraging, right? Interest rates rose, and we've really seen, even if you go to the right slide here, the 0 to 100, banks have been able to pass along those higher prices, and the smaller banks excelling even more so than the larger institutions. On the cost of funds, we see the same thing. It came down, which is great to see for the first time in a couple of years. And again, at the median, based on asset size, the smallest institutions have the lowest cost of funds. The larger institutions have a little bit more flexibility and wherewithal to pay up for deposits. But again, across the board, pretty good signals from banks of all sizes. NIM, this was one that really kind of shocked me, right? A really significant increase in NIM this quarter, which is great to see. Again, it's being realized, kind of across the board with solid, margins for banks of all sizes. And non-interest income just kind of continues to, it feels like, we've kind of bottomed here, right? That, seemingly regardless of the environment, banks at the median, right, are able to generate non-interest income at about a 40 basis point clip. Again, obviously the larger banks have a greater ability to generate those, and you can see that in the asset size bucket over here. But again, still pretty good performance for all of the banks. And then finally, efficiency ratio down for the first time in a number of years, really. And so again, the smaller banks still find it the most difficult, but again, encouraging to see a pretty good drop off in the efficiency ratio here at this quarter. All of this translates into very interesting and positive pre-tax ROA and median core operating earnings. Again, encouraging to see pre-tax ROA above 1% for institutions of all sizes, and again at the median 132. Median ROA and ROAE, again, strong increases from where we were just a year ago. So encouraging to see. And again, I think just kind of reiterates it's really been a good, strong, solid start to 2025. I'm going to show the kind of the spectrum, percentile spectrum of all those metrics, but just kind of to recap, right? Really everywhere except NPAs that David's going to touch on here in a little bit, which again, charge-offs still pretty benign, but NPAs have crawled higher. But really everywhere else across the board, we saw increases here through in the second quarter, and so incredibly encouraging to see. So again, I despite all the uncertainty, or in spite of all the uncertainty, banks we've kept our heads down and just continued to move forward, and that's translated into really strong numbers through the first half of this year. Here's the spectrum I was discussing. Again, you can see these median values all up significantly improved from this time a year ago. And I think again, very encouraging, as you can see at the median, non-performers are 39 basis points, net charge-offs at 0. I think this was 34 this time last year. But again, a really good, strong story. On Friday, we did our coffee talks. We did kind of a historical look back at the reserve, leading up to CECL and where we are now. Probably no one on this call is surprised to hear reserves have, throughout that whole period of time, have kind of been between 120 and 135. We all kind of know intuitively that's where we want to be, regulators want us to be, et cetera. So it does really almost in some ways kind of reemphasize the point that with regard to reserves, we're still playing the same game with a new set of rules. But again, still pretty good solid reserves here at the median level. All right. At this point, I'm going to turn it over to David, and he's going to talk a little bit more about loan and deposit growth and wholesale funding. David?
Well, thank you very much, Sean. I always enjoy these quarterly webinars with you and Dan and the audience. This really depicts, I think, what Sean alluded to in terms of the disappearing delta between loan growth and deposit growth, because as you can see here, and as we do, we always use our sister division, QwickAnalytics, for regional data for banks under $10 billion. And as you can see here in the really since the crisis of the funding crisis of 2023, we've been kind of flat in terms of the use of wholesale funding. It's roughly in the 8.1% national average, bookended by the Northeast at higher usage of wholesale funds and the Southwest at the lower end of that. Commensurate to that is also the same bookended effect by the same regions in terms of gross loans to deposits, which are nationally averaging at about in the 79%. Again, that I think, Sean, in many ways, exactly it defends your charts showing the declining delta between loan growth and deposit growth as well, since they both have flattened. So now we get to the credit metrics, and I do have to kind of I laughed with Sean a little earlier in the day today that, well, I'm going to try not to be the party pooper here because many in the audience may say, oh, here he comes, here's the credit. So anyway, but yeah, we are. I do feel like vigilance is the key to this because we can't bury our heads in the sand. As you saw with all the good news that basically Sean alluded to, the one fly in the ointment seemed to be a little bit of, and frankly, your polling of the audience depicted that concern of potential heightened credit stress. These are not, the sky's not falling, but I think it does certainly behoove us to be a little more vigilant around credit quality. We've clearly got the highest delinquencies we've had now in 5 years since the pandemic occurred. At this point, most of you on this call are probably more exposed to commercial lending than consumer. At the consumer lending, loan products are still leading by far delinquencies in lending at commercial banks, but unfortunately, the commercial loan products are ticking upwards each quarter. Next slide. So basically, these are the kind of the trifecta that we usually talk about each quarter. And this is of some concern to me because as you can see, since we flattened out in 23, kind of year end 23, probably as a result of the massive amount of public assistance that came out from the pandemic, we've really had a steady climb of NPLs. And again, that's continued to uptick. As Sean said, the net charge-offs are really not as material. They tend to be more focused in community financial institutions, as you know, at year end than they are on a quarterly basis. But you also see counter to that, and this is a concern of mine largely because I think investors and regulators are certainly privy to these numbers, is the continuing decline in reserve coverage. So in other words, in the face of increased problem loans, we're still seeing some decline in reserves. The Northeast in particular seems to be the interesting thing there is they have by far less reserve coverage than the other regions of the country. The next slide is the one that I normally like to see. It's kind of an inverse way to look at how much of your acknowledged inventory of problems or NPLs are being covered by reserves. Again, that continues to decline rather precipitously over the last couple of years. Also, the very fact, as you can see there, the Northeast banks are seemingly the least covered. Now, granted, that's not incorporating capital that we've had increases of since Dodd-Frank. We're nowhere near danger zone territory in that, but certainly you can't argue the trends. But again, if you look at just the coverage ratios between the all banks in the U.S., including the mega banks, and these are FDIC numbers, you've had an 8% decline year over year as of the first quarter. Unfortunately, the regulators aren't as quick to analyze the quarter results as we are. So we're still trailing in terms of first quarter. But as you can see, there's a big jump between what the all bank decline is at 8%, but community banks have actually declined in the last 12 months relative to their inventory of problem loans by as much as 42%. You know, and I know that regulators and investors are seeing these numbers. And my point there is this going to be, it's going to probably behoove you to explain. I'm sorry I missed the chat. I know that it was a question in the chat.
Yeah, so the comment is, are delinquencies in line with pre-pandemic levels? If so, do the foreclosure moratoriums account for the dip since March 20th until about a year ago?
Yes, I think there's some truth to that, but I also think that the inevitable impact of the rate shocks after the pandemic, particularly in relation to the reaction to inflation, was almost an inevitable uh, increase in credit stress. So I think that's got to be seen as and I hear most of the practical bankers that we talk with say indeed that's the residual that they're seeing where it's coming from. So next slide. Oh, the Texas ratio again. Again, this is something we don't even talk about very much. Haven't since the financial crisis. But as you can see in the Northeast banks, here we go again. This is the region of the country that has the lowest reserves compared to their inventory of problem loans. It is now approaching 10% Texas ratio. Again, remind the audience, Texas ratio is your non-performing assets divided by your tangible uh, um, common equity plus the allowance for loan losses. Again, that's a thumbnail that's used by investors and regulators, particularly at the advent of some heightened credit stress. As you've heard me say before, smaller institutions are disproportionately impacted by Texas ratio increases, largely because three things: they don't have as much capital. You tend to have that um, subjective knowledge of a lot of your problem borrowers that the mega banks don't, and most importantly, the degree to which community financial institutions depend on real estate lending, which inarguably is the most illiquid of all problem credits once it becomes a problem loan. So next slide, Sean. Thank you so much for doing this. As you can see, there's not a lot of change in our traditional look at CRE concentrations. The chart on the right, which is the broader 300% guidance, hasn't changed very much. You've got basically the West leading and the Midwest, the bookends of that. You've got 315 banks nationwide that exceed the 300% guidance. And on the construction development, the one thing that has been interesting in that chart is there is an uptick, frankly, in banks that are exceeding. Now, most of these are in the Sun Belt areas where there is potentially more justification for more construction and development in lieu of both population and economic migration. But there have been more increases in banks in the construction development area that exceed the 100% guidance. Remember, that's a guidance. It's only just behooves you to be prepared for more scrutiny in those areas. In the next slide, in terms of other traditional concentrations, multifamily, which you've heard me say before, is of some concern to me due to overbuilding in some markets, even in some dynamic markets. And then does continue to increase at the smaller financial institutions under $10 billion. C&I continues to go back to its kind of norm after the PPI environment. And of course, agriculture, which at this stage remains one of the most problematic industries right now across the board, is not as exposed nationally except in the Midwest in terms of commercial bank numbers. So next slide.
Yep.
I'm sorry. I mentioned again, if Sean, I appreciate you monitoring that if it's pertinent to anything I'm saying. But this slide is really, again, you've heard me say this repeatedly, the disproportionate amount of CRE exposure that is being borne by the smaller financial institutions. 79% as of June 30th of all commercial banks under $10 billion have some form of have real estate secured loans. And as you can see, the chart to the right per Loomis sales is also showing, again, disproportionate number. The real concern there is, CRE is going through some obsolescence, frankly, because of technology and the way we utilize real estate. But it is very local, and the trends are quite demonstrably different depending on not only the locale, but also the loan product. So I do feel like that you have to be very sensitive to, again, as I said before, the illiquidity of a problem real estate loan can be very, very problematic for banks. Next slide. So these, I think I started this a couple of quarters back in terms, this is not empirical evidence. This is not based on real estate professional brokers per se. What it is a conglomerate of our knowledge of the nation. We're now doing loan review work in about 38 states in all sorts of regions, from banks of 25 billion down to 170 million. So we pretty much covered the landscape in credit risk nationally. And it's our sense particularly from loan review, is these loan products to the right under more stress. The one difference we've added this quarter is 1 to 4 family housing. That may be a surprise to several people, but and there's been some mixed metrics of the last month over whether the mortgage industry is beginning to recover with some more stabilized rates or not. But the reason we put it in here is we've had a couple of clients that have talked to us about some tract building inventory that is just sitting idle right now, is either due to the cost of the product or people walking from contracts. And there's a growing concern that by some bankers that they're beginning to show some heightened inventory, particularly with the tract building construction lending. So that is why we've kind of moved that. And as we all have said, we've still got a lot of repricing yet in the pipeline that we have to do based on interest rates. Okay, next. And then I would like to conclude kind of my portion of this is an article I just wrote for Bank Director, got published about 2 weeks ago. For those of you that are in more of the funding and finance area of banking, you've been involved and used to so-called contingency planning, at least for the last 3 years, particularly ever since the big five, or I'd say the big four and the small bank that failed in 2023. All but the small one was really funding and deposits, or liquidity. It wasn't anything to do with credit. But the reality is, the gist of the article was, for those of us in the credit world, why don't we start beginning to think in terms of planning contingencies for heightened credit risk? We're already seeing clearly the momentum. It's not anywhere near alarm status, but clearly the momentum is there that more heightened credit stress is appearing over the horizon. Specifically, what we recommend is update your loan policies. Make sure you're not sitting there with 10-year-old loan policies that, for example, would have, oh, well, we're trying to grow CRE loans, so we're providing 3-year interest-only loans, things of that nature. Loan policies can be a trap, frankly, that are used against you, and you need to make sure they are relevant and pertinent for the current environment. I don't know of anything that's changed more remarkably in credit analysis than this next point, which is assessing industry risk. It's not about doing classic credit analysis. We do know how to do cash flows, and we do a great job on global cash flows, things of that nature. It's really the industry behind whatever operating company or even whatever type of loan product, real estate loan product you're financing, needs to be understood. And we're big advocates, and we've basically armed our own reviewers with a lot of data to understand what the industry risk behind the loan opportunities may be. Obviously, quantifying the supply and demand of the CRE, as I said before, CRE is very much a local issue. And I do think it behooves you to understand what is the nature of the supply and demand within the markets you're financing. We've not had workout capacity needs in the last 10 or 12 years. Many of the people that were experts in that have either are out of life or out of the industry. So reality is you need to plan, I think, as a contingency of what do we do if we start having a larger inventory of problem loans. Make sure the board's aware of all these things. This seems to be a common theme in the regulatory orders that we see, and that is that the board is not as apprised of some of these changing trends in credit as they should be. I do think while loan growth is clearly, as Sean alluded to, is certainly something all banks aspire to, maybe this is time to make sure you're a little more discerning in where that loan growth should be. And finally, you've heard us mention these. These, in fact, are the hallmark of what IntelliCredit's all about, is these three pillars of what we consider the post-booking credit risk management protocols. And they are stress testing, which we do offer two methodologies in terms of our ability to do both the companion stress test with loan review or a broader, more sophisticated stress test for the entire portfolio at a loan level basis, which obviously ends up to giving you the kind of the top 10, top 25 credits that under the theoretical stress might be worthy to keep an eye on. Portfolio analytics, which of course is your DNA. Unfortunately, we still see that the smaller banks don't utilize or don't have the tools or employ the tools to understand their DNA. Remember that the first signs of credit stress don't come from the call report. They come from your migration of risk within your past categories. And that's best determined, of course, by using very robust portfolio analytics. And then finally, of course, good loan review. Make loan review now very much a partner in your risk management strategies. Use seasoned people. Make sure you ask for bios. We'd love to be, frankly, in your RFP queue. This is the season for that for 2026. But again, I don't know of any three investments that a bank can make to try to aspire to that age-old axiom in banking, which says early detection of credit risk always relates to fewer losses down the road. So, having said that, Dan, I'll hand it to you, sir.
Thanks, David. So just as a little bit to set the stage as we transition here, the infusion perspective is nearly a nationwide sample. It's drawn upon 363 data sets where we have specific customer level data feeds. And so one part of that is a broad perspective. The other part is what we do working with banks to actually run strategies and campaigns to make a difference in their balance sheet. And so just to put that, kind of pictorially, the work and the perspective that we've highlighted there on the next slide is the infusion norm databases. So there's really two proprietary assets that we bring to bear. One, the kind of, if you think about it, the big picture norm is insight into how individual consumers and businesses interact with used products and services provided by hundreds of banks and local financial institutions as they manage their financial life. So the customer perspective, of course, is the inverse of the bank's balance sheet. They are borrowing, or they're essentially lending money to the bank through deposits as a savings need. They're borrowing and then transacting is a key fee income source for the bank. So we have this granular perspective on how 50 million households have interacted with products and services with banks. That's kind of the big picture. But then the other twin of that is the campaign tracking norm database, where when we do work with banks on campaigns or just analysis, so we analyze campaigns that we don't necessarily execute, but they want a perspective on, we're understanding what is the right combination of audience, offer, channel mix, creative package that's necessary to drive an outcome. And so, and we're doing that, comparing it through peer averages. So it's not just one thing. So these two data assets give us the perspective of understanding kind of what's happening at kind of macro customer trend level, but then also specific campaign treatments. And so that's why we talk about this section is kind of what's happening within customers. And the next page steps back up a little bit. So as we know, deposit growth kind of ebbs and flows. Sean's data before touched on several awesome cuts of that for peer groups. But sometimes in my 25 years in banking, there's a temptation to think about, okay, when deposit cost funding declines through rate cuts, is that going to impact growth? Or on the flip side, is it sort of, lazy money? Okay, I can get my NIM through just harvesting cost cuts, and I don't really need to worry about growth. But there is a dynamic environment going on, and we still see, even in rate cuts, a lot of growth happening in the marketplace. And so the really smart banks that we talk to are the ones that are proactively thinking about, how do I reposition my strategy to get the kind of sustainable growth through different rate environments. And so one of the tools that they're using is they're looking at, okay, what are others seeing in terms of campaign activity? What are they seeing in terms of product usage? And that benchmarking helps inform a very robust kind of forward-looking customer strategy, because we all know that organic core customer relationships are that much stickier on the deposit side of the balance sheet, and then usually you can be higher quality on the credit side of the balance sheet, or at least you could be, where you're focusing, you can use that to help get the right kind of quality that's going to perform in the cycles that David talked about. So just a couple of trends that we'll look at together on the next page. Core consumer checking is just the foundation of the relationship. And so one of the things that we watch very closely is what is just the average household checking balances. And they're pretty healthy. In fact, they're growing. They definitely spiked up during the pandemic. They were moderating there as that excess liquidity came out of the system and as rates rose. But the trend we've seen, developing the last few quarters is a really stable average balance at the household level for checking balances, and then a pretty stable interest checking penetration. So it's certainly coming back up since the rates made interest on a checking account matter. But we also see people still very much differentiate between kind of the savings vehicle and checking. They view checking as truly, daily cash flow management, where they see that on the consumer side. And so they tend to be a little bit less sensitive to the interest checking component on the account. But we watch both of those very closely. Next step on the trends tour is looking at CDs. So this is, obviously with the interest rate environment, we're seeing the interest in CDs going up. We may see that kind of stabilize as we get further into the rate cut cycle, but average balance per household using CDs and penetration in other words, the percentage of consumer households using CDs continues as kind of an upward climb. And then the next slide looks at money market. Of course, money market is an interesting one because that's truly the more rate sensitive component. When we look at savings, we do see some, people tend to be a little bit less rate sensitive than savings, but money market balances have been fairly steady, even as we've entered the cutting part of the cycle, but penetration rates have ticked down. So people are, as consumers are definitely aware that, they're likely to earn less on their money market accounts into the future. That's kind of the flip side of the CD penetration story. That's big picture and just penetration rates at banks. Looking at some campaign performance, we're definitely seeing some return to the mean for both the CD and the money market bucket. So the long-term average for CD campaigns is about 2% response rate, and that's booked account to targeted campaign audience. And so you can see we were well above the long-term average in 2023, and it stayed elevated really a little bit longer than we even expected to see it in 2024. But it's reverting to that mean. In fact, Q2 it came in almost exactly on top of the long-term average for CDs on the left. Money market's still running a little above that long-term average, as people like the flexibility relatively, but even that's showing some reversion there in Q2. But the key point is there is activity to be had with the right kind of focused effort, and these kind of response rates. These are tangible booked account response rates. It's not we're not using clicks or anything like that as a proxy for it. This is okay. How many are actually opening accounts compared to the outreach? So that's deposits. Next stop on the tour is some asset side of the balance sheet. And so home equity is something that we watch really closely. In terms of average balance, we are seeing an increase in the average balance of households using home equity, which is exactly what we'd expect to see this part of the cycle. Just as people are drawing down on existing lines, or more interested in tapping into their home equity, as opposed to refinancing an entire mortgage where those rates are. So that's home equity. Credit cards. It's interesting. We look at the next slide is credit cards. It's kind of a tale of two cities. So we see community banks being very conservative in the credit card space. Now, some of that is the arrangement. So this is the actual balance sheet credit card, right? If there's a referral relationship, it wouldn't be picked up in this data, but we see on average 3.2% of consumer households at community banks have a credit card with that bank. Obviously, the number of people who use credit cards is overall is much higher. So you see there's some conservatism there when it comes to the piece of the balance sheet, some combination of conservatism and less strategic priority. What's kind of interesting is credit unions, which we know banks compete with in certain buckets, tend to be much more aggressive in the credit union space. Now, some of that's a customer mix, but we see actually the penetration rate of credit cards at credit unions went above 20% in this last quarter. So a little bit of a tale of two cities there. And then the last trend that we're going to look at is just unsecured, or I should say non-real estate secured consumer loans. So this is just macro activity, and we see credit unions being more aggressive. Of course, they're historically not nearly as disciplined on the pricing side for unsecured credit, and so we see campaign activity for consumer loans at credit unions running north of 2% and climbing through this first part of the year, whereas bank response rate for consumer loans, it has been a lot more consistent. Still, 1.2% response rate is a really healthy response rate. Banks tend to see about twice the average balances with responders. So there's an emphasis mix in terms of the products promoted, but also in some ways just the capacity of the borrower at banks. And so really the takeaway from this chart is that banks that are thoughtful about generating quality credits, taking into consideration all the factors that David and Sean talked about, is there is quality growth available, embedded in particular in the bank's existing customer base that, with the right data-driven strategy, can be managed to give a good risk-adjusted return, but also enhance overall relationships. And so that's it for me. Back to you, Sean.
Thanks, Dan. Again, just kind of wrapping up in the chat feature or in the chat area, we posted, if you have any questions or you want to see the QCBI reports, for your state or nationally, there's a link in there you can go to. If you're not a QwickAnalytics customer, you can certainly request a state and national report in here as well. So I'd certainly refer you to the chat where you can see those items. Again, I think I'm really, frankly, quite encouraged. Right? Let's we'll get together here again next quarter, but let's keep the momentum going in spite of the uncertainty. I look forward to seeing the third quarter numbers. Keep fighting for those deposits. As David said, remain vigilant in managing your credits. As Dan touched on, right? Stay consistent with outreach to your customers. Identify the customers you want to go out to with the campaigns that you want to, and stay consistent. And congratulations on a great quarter, first half of the year. A couple of items, if you are interested in a complimentary opportunity assessment. The opportunity assessment is where you share some data with our infusion marketing team, and they bring back and show you the opportunities in areas where you deviate potentially from the norms, and they can make customized recommendations and suggestions on outreaching to your clients. You can reach out to Dan directly or Trevor Knott. Both emails are listed there for your convenience. With regard to IntelliCredit, we've shown this before. David touched on it, right? A number of different ways you can interact with our team there. One, traditionally the third-party loan review, but we have built data solutions, software solutions that you can use within the bank, headed up by a portfolio analyzer. So again, encourage you to reach out, learn more about it. The integration is negligent. It's really easy to get you up and going, and we'd welcome the opportunity to talk to you about that as well. The easiest way to do it is just take advantage of our 3-month free trial. So the information's there for you to do that. Again, I think you'd really be surprised at what this can do for you. We do the trial for a couple reasons. One, to make sure the data is in a format that you can benefit it from. Secondly, is to teach you how our other users utilize the tool and give you some suggestions, hopefully help you replicate any reports or create new ones that you might want within your institution. But it just really gives you an opportunity to take a really fresh look at your loan data. And then finally, we have a few upcoming webinars. If you want to learn more about the analyzer, you can and the loan review software tool, register for our webinar tomorrow. Again, with all of our webinars, if you register, you will receive a link to the presentation and recording. But we will have Matt Wright on from Lincoln County Bancorp, who utilizes the tool within his institutions. And then on October 3rd, the infusion team will talk current loan strategies with bankers as well. So, I know we do these presentations. We do a lot of discussions with you. These are two opportunities where you can actually hear it from bankers themselves, how they benefit from the tools and solutions that we have to offer. So again, I encourage you to register. Even if you can't attend, you'll get a link to the recording and obviously the presentations.
And Sean,
Yes.
if you don't mind, I'd like to put a plug in for we have a webinar on September 17th that I'll be joined by Executive Vice President Credit Officer of a bank. And really, since we're in the middle of RFP season for loan review services for next year, he'll lead the webinar basically on what does loan review do for a bank and what should be the best practice expectations for loan review.
Fantastic. Yeah. So look for that one as well. Okay, we do have a question that came in. Given that more homeowners are staying put due to high interest rates, I would have expected HELOCs to have been increasing much more during recent years' quarters due to home improvements. Has there not been an increase in home improvement projects or are homeowners funding such by other means? Thoughts for Dan, David? I'll share mine, but
Yeah.
I'll let you guys go first.
Yeah. So we see the that's exactly what we see, an increase in home equity. Now that perspective was the kind of the customer level view at community banks. I'll let well, so there may be an even higher run up kind of in the macro picture. I haven't looked at for a while if national banks are gaining more share in home equity, but we definitely see very solid increases in usage and average balance and penetration at the banks we work with.
Yeah, I would add that I would think that more once rates got so to speak more stabilized, and from a mortgage perspective, you'll see even higher increases in HELOC use. I
Yeah,
think
and I would probably
I
just
think I think
yeah.
people are afraid of touching the home one way or the other, either through a full mortgage, as Dan said, or a HELOC, given the rate. But as they decline, I would think that becomes more used.
Yeah, and I think just overall, right? I mean, I think we've seen it in the volatility in the consumer confidence, right? I think there's just the one thing the uncertainty of this year has definitely done is it right. I think it's just put people on hold on everything, right? And I think we've kind of seen that kind of across the board. But if any of the consumer sentiments, it's been a little bit of a roller coaster here this year. And again, I think people are the uncertainty probably has had some impact on that. Thank you. Thanks for the questions and chats today, Stanley. Thank you. Just a reminder, all of our historical presentations can be found on our YouTube channel. You can see the link at the bottom. So certainly encourage you to go back if there's anything in particular you're looking for. A question came in, how do we register for these other events? We can certainly get you, Ken, we can get you registered, but if you go to the QwickRate website, and go under on the bank tab, there's a webinar on the homepage. There's a webinar tab, and you can register from then. But I will forward I'm going to make a note, and we'll go ahead and register you for those upcoming webinars. So bear with me 1 second, and I will make a note. Okay. Yeah, just a reminder, we're happy to help that, but I certainly encourage you to register so that you can always get a copy of the presentations and a link to the recordings. So again, any final questions, go ahead and submit those now. If not, any final words, David and Dan, before we let everybody go?
Yeah, the national rate of home equity lines, according to the Fed, is up about 3x this year in terms of the growth rate from
Okay.
well, certainly since 2023. So
Very good.
but you think about it, it's kind of a moderate rate. I mean, moving the balance sheet, it's not gonna, we never see balance sheets increase 15%. That's when David gets really, really worried.
Well, and to that point, I would like to again congratulate the industry for a great performance. But I think one of the things that you always see in credit cycles, they can be contagious, right? And they can
That's
change
right.
quickly. And vigilance is the key. I've been saying that for years now, but I think that's what would you expect from me to say?
That's right. That's right. Yeah. I mean, that's the industry, right? I mean, we've
Yeah.
all been around long enough. If growth gets too hot, that's when you get in trouble.
There you
Yep.
go.
It's the Goldilocks. It's the Goldilocks target.
Yeah, that's why this kind of just steady thing has been good for the industry this year. All right. Well, again, thanks to David and Dan. Thank all of you for again taking time out of your day to join us. Certainly register for those upcoming webinars. We'll look forward to seeing you on one of those future ones. In the interim, if you'd like to talk to us, schedule a demo, certainly reach out to us by phone or info@quickrate.com. We'll route you to the appropriate team member and get you all set up. So again, thanks for taking the time to be with us today. Hope you have a great day, and we will see you soon. Thank you.